It is December 23, 2025. 2 days before Christmas. In a normal world, the building you're looking at right now, India's largest toy factory, would be chaos. It should be a deafening symphony of hydraulic presses, shouting foremen, and forklifts sprinting across the floor to load containers bound for the port of Los Angeles or Newark. This facility was built to be the engine room of the new global economy. It's a 2-story behemoth, large enough to fit 11 NFL football fields inside. But today? It's a ghost town. The warehouse is eerily quiet. Rows of shelving, stretching from the polished concrete floor to the ceiling, are packed with blue plastic bins wrapped in dust-gathering plastic. Inside them lie millions of dollars of inventory, half-finished dollhouses, the plastic shells of miniature black sports cars, and components for water pistols. They are stuck in purgatory. Why? Because of a single signature signed 8,000 miles away in Washington, D.C. On August 6, President Donald Trump, deep into his second term, dropped a geopolitical nuclear bomb, a 50% tariff on Indian goods. The official reason? To punish New Delhi for purchasing Russian oil. The real result? A catastrophic freeze in the global supply chain that is currently draining the liquidity out of American retailers and threatens to turn your stock portfolio into a sea of red. If you think this is just a story about toys, you are dead wrong. This is the canary in the coal mine for the S&P 500. This is the death knell of the China plus one is strategy that Wall Street has been betting on for the last 5 years. Today, we are peeling back the layers of a trade war that has gone from cold to scorched earth. We're going to look at why your cost of living is about to spike, why reshoring jobs is a mathematical lie, and why a factory owner in Bangalore holding $20 million in dead stock is actually a warning signal for the US dollar. Buckle up. The supply chain just broke. Let's rewind the clock. 3 years ago, Vijendra Babu, the managing director of Microplastics Private Ltd., was the golden child of the new India. He bet the farm on a simple premise: the West is done with China. The narrative on Wall Street was clear. Tensions between Washington and Beijing were too high. Companies like Apple, Tesla, and yes, toy giants like Hasbro, Mattel, and Spin Master needed a new factory floor. They looked at India, a democracy with a massive labor force, and saw the future. Babu's business was doubling every 2 years. He invested $30 million, a fortune in the developing world, to build a state-of-the-art facility. He was churning out Nerf guns and Paw Patrol trucks, the kind of stuff you see filling the aisles at Walmart and Target. He was so confident in the orders from U.S. corporations that he built a second, 250,000 square foot facility right next door. That building is now empty. Not a single machine has been installed. Babu was projecting 40% growth this year. Instead, he's looking at a 15% contraction. He is sitting on $20 million of inventory he cannot ship because a 50% tariff makes his products unsellable in the US market. Another $15 million in new orders are on indefinite hold. Now, let's translate this into Wall Street terms. When a manufacturer like Babu holds $20 million in inventory, that is trapped capital. That is money that cannot be used to pay wages, service debt, or buy raw materials. In finance, we call this a liquidity crunch. But here is where it hits you. The companies contracting Babu, the Hasbros and Mattels of the world, operate on thin margins. When a 50% tariff hits, they have two choices. Option A, they eat the cost, which destroys their earnings per share, sending their stock price tumbling. Option B, they pass the cost to you, the consumer. Suddenly, that $30 Nerf gun is $45. That $60 doll is $90. This is what economists call cost-push inflation. It's not caused by high demand, it's caused by a supply shock. And unlike demand-driven inflation, the Federal Reserve cannot fix this by raising interest rates. Jerome Powell can hike rates to 10%, but he cannot print a shipping container or erase a tariff. The irony here is brutal. The tariffs were imposed because India bought Russian oil. India, acting in its own economic self-interest, bought discounted crude, refined it, and kept its economy running. The US response was intended to squeeze India, but the recoil is hitting the American consumer right in the wallet during the critical Q4 holiday shopping season. Babu is now keeping his assembly lines moving by producing at cost, making zero profit just to avoid firing his 2,000 workers. He calls it a pause to rework strategy. But let's be real, in the corporate world, you don't pause indefinitely. You eventually bleed out. This brings us to the most dangerous myth currently circulating in American politics, the idea that these tariffs will bring manufacturing jobs back to Ohio, Pennsylvania, or Michigan. To understand why this is a fantasy, we need to take a field trip. We're going 3 hours north of Babu's factory, to the outskirts of New Delhi, to visit Amitabh Kharbanda, the owner of the Sunlord toy factory. Kharbanda produces something he calls his trump card. It's an all-fabric Elsa doll from Disney's Frozen. Walk through his factory, and you won't see robots. You will see dozens of women in colorful tunics sitting in rows. They are hand-sewing 3-foot-long yarn onto the doll heads. They trim the hair, comb it, and hand-braid it into an intricate fishtail pattern. They sew the blue beaded dress, the tulle cape, and embroider the eyes, mouth, and nose. It takes 4 hours of intense manual labor to make one doll. Now, let's do the math. I want you to pull out your calculator. The doll retails in the US for about $60. Retailers typically take a 30 to 40% cut. That leaves roughly $36 to cover manufacturing, shipping, marketing, and profit for the brand owner. In India, Kharbanda pays his skilled workers about 20,000 rupees a month. That's roughly $220 per month. Now, imagine moving that job to the United States. Even if you paid the federal minimum wage of $7.25 an hour, which, let's be honest, you can't hire anyone for in 2025, 4 hours of labor alone would cost $29. That's $29 just for the labor. Add in materials, factory overhead, electricity, insurance, and shipping, and the production cost balloons to over $50. If the brand wants to make a profit and the retailer takes their cut, that Elsa doll now has to sell for $120 to $150. Who is buying a $150 doll for their toddler? Nobody. Kharbanda puts it bluntly, you couldn't move that to America at a commercially viable price. Furthermore, it's not just about money, it's about skill. 70% of Kharbanda's 225 employees have been working there for over 25 years. They are artisans. You cannot take a worker in Detroit who has been trained for automotive assembly or service industry work and expect them to master intricate hand embroidery overnight. The human capital infrastructure doesn't exist. So, when politicians tell you tariffs are about protecting American jobs, they are gaslighting you. In this sector, the jobs aren't coming back. The production will simply move to the next cheapest location, maybe Bangladesh, maybe Africa, or prices will skyrocket until the American middle class simply stops buying. This is exactly what happened with the Smoot-Hawley Tariff Act in the 1930s. We tried to protect everything, trade collapsed, and the Great Depression deepened. We are flirting with history again, and the stock market hasn't fully priced in the risk. For the last decade, the global investment thesis was China plus one. The idea was that you keep some manufacturing in China, but you hedge your bets by moving operations to Vietnam, India, or Mexico. India was supposed to be the heavyweight champion in this fight. It has a population of 1.4 billion, a labor force of 600 million, and a government hungry for growth. But here is the dirty secret of the Indian economy: it is still haunted by the ghosts of the past. For decades after its independence in 1947, India operated under the license Raj. The government required permits for almost everything. It was a closed, protectionist economy. Manufacturers got lazy, fat, and inefficient because they had no global competition. It wasn't until 1991 that the doors flung open. In 2020, Prime Minister Narendra Modi tried to turbocharge this with the National Action Plan for Toys. He jacked up tariffs on imported toys from 20% to 70% to force local production. And on paper, it worked. Imports plunged. Exports grew 42% to $571 million. The industry is targeting $3 billion by 2030. But let's look at the scoreboard. China's toy exports, $11 billion. Vietnam's toy exports, $3 billion. India's exports to the US? A measly $100 million last year. Why is the gap so massive? Because India lacks the ecosystem. Making a toy isn't just about assembling parts. You need specialized synthetic plush fabrics. You need electronic chips for the talking action figures. You need high-quality plastic eyes for the teddy bears. Guess where India gets those components? China. India has a tricky, often hostile relationship with China. There are border disputes, visa bans, and political tensions. Mainland Chinese entrepreneurs are hesitant to invest in India or transfer technology. Compare this to Vietnam. Vietnam hates China politically too, but economically? They are practically married. Vietnam's factories are often owned by Chinese capital, using Chinese supply chains, just across the border. It's seamless. India is trying to leapfrog this by doing it alone, but as Kharbanda admits, we have to learn from the best. American companies spent 30 years transferring technology and know-how to China. They haven't done that for India yet. And with Trump's new 50% tariff, why would they? If you are a CEO in New York looking at your 2026 supply chain strategy, India just went from the next big thing to too risky to touch. So, is this the end for Indian manufacturing? Not necessarily. The Indian entrepreneur is nothing if not resilient. They are pivoting, and this pivot is a fascinating lesson in Plan B economics. Kharbanda and his competitors are doing something rare in the cutthroat world of manufacturing: they are teaming up. Realizing they can't compete individually against the Chinese behemoths, Kharbanda has joined forces with two local competitors. They've rented a 28,000 square foot facility to share high-tech equipment. They are installing laser cutters, computer-guided machines that can slice through plush fabric to create elephant ears and trunks with a precision and speed that no human hand can match. They plan to run this facility 24/7. It's a co-op model of industrialization. They are also looking inward. This is the one advantage India has over almost everyone else: demographics. China's population is shrinking. The West is aging. But India? India has 350 million children. That is more than the entire population of the United States. Carbunda's Plan C is to ignore the US market entirely and focus on the hundreds of millions of Indian parents, grandparents, and uncles who want to spoil those 350 million kids. They are expanding into Bihar, one of India's poorest provinces, to set up 300 sewing machines for the domestic market, scaling to 1,000 soon. A rising tide lifts all ships, Carbunda says. This is a classic shift from export-led growth to domestic consumption. If the US closes its doors, India will look inward. But here is why this matters to your wallet in London or New York. If emerging markets like India stop trying to export cheap goods to the West and focus on their own consumers, the era of cheap stuff is officially over. For 40 years, the West imported deflation from Asia. We got cheap TVs, cheap clothes, and cheap toys, which kept our inflation low. If that dynamic reverses, if India, Vietnam, and Brazil focus on their own middle class, prices in the West will permanently reset higher. So, what does the future hold? As investors, we need to probability weight the outcomes. Scenario A, the art of the deal trumps 50% tariff is a bluff. It's a negotiation tactic to force India to stop buying Russian oil or to lower its own tariffs on US goods. In this scenario, a deal is struck by Q2 2026. The tariffs drop, Indian factories roar back to life, and stocks like Hasbro and Mattel rally hard. If you are a contrarian investor, buying the dip on these beaten-down consumer discretionary stocks now could generate massive alpha. Scenario B, the stagflation grind, the tariff stick. The US enters a prolonged trade war not just with China, but with the entire global South. Supply chains fracture. Companies scramble to move production to Mexico, but Mexico's infrastructure is overwhelmed. Result, inflation in the US settles at 4 to 5%. The Fed keeps interest rates higher for longer. Mortgage rates don't come down. Your move, you want to avoid companies with complex, low-margin supply chains. Look for companies with pricing power, luxury goods or essential services. Avoid the middle. Scenario C, the bipolar world, the global economy splits in two. The US and its tightest allies on one side, China, Russia, India, and the global South on the other. This is the worst-case scenario. It destroys the efficiency of the global market. Result, a massive rotation out of the US dollar as the global South looks for alternatives to avoid sanctions and tariffs. Gold and crypto likely outperform in this chaotic environment. Vijendra Babu and Amitabh Carbunda are just two men in a sea of billions. But their empty warehouses and silent machines are sending a message loud and clear. We are witnessing the unwinding of globalization. For 30 years, we prioritized efficiency. Now, we are prioritizing politics. Politics is expensive. When you walk into a store this Christmas or next Christmas, and you see that price tag, understand what you are paying for. You aren't just paying for plastic and labor. You are paying for trade wars, sanctions, and the geopolitical struggle for the 21st century. The Indian toy industry is bracing for the worst. Plan A, tariffs go away. Plan B, expand markets. Plan C, focus on India, says Carbunda. You need a plan A, B, and C for your portfolio, too. Because if the factories in Bangalore stay quiet, your purchasing power is going to scream. Thanks for watching. If you want to understand how the oil markets are actually driving this trade war, check out this video here. And don't forget to subscribe and hit the bell, because in this economy, what you don't know will cost you.